Welcome back to FANG Friday. I'm Ross Healy, Chairman of Strategic Analysis Corporation. To all of our regular viewers, nice to have you back. And to those of you who are watching me on BNN today, a special welcome. I'm going to take you into the world of structural valuation analysis, where fundamental and technical analysis come together. Welcome. Now let's see what's going on in the world of FANGs. Okay, the first stock that we are going to take a look at is Amazon.com. And for those people from BNN who are tuning in for the first time, I want to point out that the breakpoint values here, which are, there's four of them shown here, flow from the mathematics of structural valuation analysis, and these are actually power law multiples of book. So the HB3 level is actually close to about 16 times book as a sort of a round number, and the HB4 as a round number is about 20 times book value. Currently, you can see on the side here, the MV ratio, that's the price to book, is about 18 times, and it's splitting the uprights, as it were, of the HB3 and the HB4 levels. You can see, by the way, how nicely those breakpoints work in terms of turning the shares when they come down and hit or rise up and bounce down again. Anyway, so what's happening with Amazon today? Well, it turns out that Warren Buffett, or Warren Buffett's company, one or the other, anyway, is interested in buying, or is buying, a slug of Amazon, and the stock has had a nice jump to about 1960 from the 1900 where it closed last night. It's getting close to the HB4 level. That's 20 times book, but it hasn't got there yet. I don't know what's going to happen when it gets there. My sense is that that's going to be pretty extended, and as happened here and here, it probably is not going to make it through, and we will essentially get a short-term trading sell signal on the company. Now let's turn to Facebook, which is the other stock that I said today that we would rate as a buy or a good buy hold. And the reason is that Facebook has broken out over its mid-super growth price. That's 5.5 times book value. You can see it's trading at 5.64 right here, 5 times book value. What we do when a stock makes a breakout is we typically use our 3% 5-day rule. In other words, the stock needs to break out by about 3%, and it's got to stay there for about 5 days. And Facebook has nearly met all of those, or both of those criteria. So I think it's fairly safe to say that the stock is now a buy. The target would be its bubble price. That's $252. That, by the way, is also a power law. It's 1 over E squared, or 7.4 times book value. So there is our second of two buy holds. Now here's NVIDIA. And I have to take you back now for a few months to where the stock actually bottomed. Here was the stock failing to hold at its HB3. That would be about 12.5 times book value. This is what we call sloppy trading here. This kind of trading here, it sort of goes through back and forth. Very, very weak trading, and typically indicates that the stock is going to drop another breakpoint. And notice we had exactly the same kind of trading here. But down here at the bubble price, that's 7.4 times book value, we got a lovely bounce Look at that. We got a bounce and a check back, and then we got the first move of the stock up to its HB1, which is about 10 times its book value. A very quick check back to its bubble price once again. But then after that, the stock begins to march forward. Now, you will notice that the bubble price in the previous chart was higher than the bubble price here, and that's because in the intervening period we got a new balance sheet for the company, and the balance sheet aggregates were lower for this time around than they were for the last time around. So in a sort of a sense, the bottom has fallen out from underneath the company, but that's okay. The company has marched steadfastly onwards after really a perfect bottom. And anytime a stock comes off its bubble price, that's a very, very, very powerful technical and mathematical breakpoint. And it is trying, I think, to head to its HB2, and that's about 12 times book value. It's about trading at 11 right now. This is a company which is going to be reporting next week. And I have to just warn you that the semiconductor stocks have been running into some major headwinds from a business point of view. By and large, the market has kind of shucked off the bad news for NVIDIA, although it has set back, and for some of the other companies. But if the companies have not got the analysts primed for disappointment, if you spring disappointment on the market, it will tend to react very badly. So what I'm saying is that if the stock gets much higher, maybe it will get to its HB2, and of course it would do that if the company manages its analysts properly, and therefore they will get a sort of a positive surprise. If they do not, then the stock may well set back. If I own the stock, I would take a little bit of my money off the table just in case they are unable to manage those expectations very well. Anyway, 200, 204 remains my target. And now here's Alphabet. Alphabet sort of did a nice, see, it broke down here at its low super growth price. That is 4.5 times book value. But never got down to its super growth price. Very annoying, by the way. You know, when you see a company heading down to an absolutely perfectly beautiful buy point, which the super growth price is, and then it doesn't quite make it because the market turned prematurely, and then kind of use around, comes up, and look at that. It gets up to its low super growth, sets back, comes up again, tries actually to break out. It broke out by about $2, but again, it did not meet the 3% 5-day rule, and then reported very poor earnings, and of course, wham, down comes the stock. And so at this juncture, I would have to say we were not in the stock when the stock got to its low super growth price, because that was a sort of a visible maximum. At this juncture, I would be waiting perhaps for the stock to actually meet its downside target from all of this, which would be its super growth price, or about $980. Here's Netflix trying to break out over its HB5. The HB5 is 25 times its book value. Has not been able to do that. This little setback here, of course, was due to the announcement of Disney in terms of entering its own streaming service and taking some of its great movies away from Netflix. As well as that, of course, there have been reports that new subscriptions are really slowing down. Anyway, the stock is having a very, very difficult time at its HB5. Allow me to point out that the fair market value is minus 78% lower than the current price, or $81. Now, you may look at that and say, whoa, come on, Ross. Well, if we take a look at the long-term view of Netflix, we can see that that kind of drop is not unprecedented. Here the stock was way up there at one of those high break points there, and look at the decline there. It did from $40, equivalent of $40, down to $7. Well, if you still think that minus 78% is an unreasonable target for the stock, allow me to remind you that this would not be the first time that this company has done that. Finally, among the FANGs here is Apple. Now, Apple, as I said on BNN to those of you who tuned in, had an absolutely grisly quarter, and sales were way down, and earnings were really soft. However, they beat very short-term expectations, and the market got all at Twitter and fired up into the atmosphere. But this company is very, very highly valued. And to begin with, its fair market value, which is that dotted line, has tended to constrain the shares through most of all of the past 10 years. And that's roughly where the stock is right today. So after a perfect bounce off its mid-super growth price, where actually it had value, had upside potential off here, and it hit that level. That level, by the way, 5.5 times book value, is quite interesting, because for the previous 10 years, look at that, the stock tended to peak at that level. So when it broke out on the fact that the company had been buying back stock, and then it got into a bearish market, it's not surprising that it would bounce at its old peak, and it did. But look at the fair market value. It's beginning to roll over. Let's see if we can see this a little more closely. You see it's falling steadily. I would guess maybe that the stock has pretty much met its peak. I would be very surprised if it got through the bubble price. That's $221. Again, that would be expensive on both counts, technically and fundamentally. So I would be very careful of this company. Now, before I leave this particular webcast, I'm going to take a look at a stock that I talked about as being a buy, and that is CVS Health. And here is a 10-year look at CVS Health. And look what it shows. Okay, it bottomed at its end price. Its normal price is its book value of 1. Here it's just a little bit above that, 110. Okay, over the past 10 years, had a beautiful run right up to its fair market value, and then quit. And then a setback. Now, some of the setback, of course, is due to the new political realities that healthcare costs in the States are becoming an increasing concern to both parties. And the issue is, how are those costs going to be reduced? Well, CVS has its own answer insofar as it bought Aetna and will sort of consolidate, if you like, both sides of the healthcare equation. So far, there's been a little bit of a turn down in the earnings and the fair market value, which you can see here. But beyond that, the upside potential remains actually very strong. And we are very much inclined therefore to be interested in this company for a very nice tradable move. Our initial thoughts on the stock would be that it would get to its HC price. That's about 1.5 times book value. That would be $74. But look, the stock just in the past year has been as high as 2 times book value. So that would be 102, and that's still within the confines of the fair market value, which is $136. So this could be a very interesting investment right now. One last item in terms of looking at the quality of the balance sheet. There's a lot of goodwill on this particular balance sheet. But what we do is we take a look at the book value, and that is the normal price, that is the book value is $51. And then we look at the earnings forecast and we say, well, what is the implied ROE of that stock? And it's about 14%. Well, if all of that goodwill can generate a return of 14%, that goodwill is clearly worth an awful lot more than zero. And therefore, we are inclined to treat that goodwill as being a genuine part of book value. Okay, so that was a look at the FANG stocks for this week. And I hope that you didn't mind if I threw in CVS as a kind of a special feature, because it has hit us as being a potentially very interesting company. At any rate, this is Ross Healy, Chairman of Structural Valuation Analysis, reminding you that nothing, including investing, is difficult if you've got the right tools. See you next time.